Welcome to the deep dive. We're digging into the, well, sometimes wild world of cryptocurrency today. We're going to cut through some of the noise around a pretty big shit, something on a lot of minds. Why Bitcoin and really the whole crypto market took this multi-billion-dollar nosedive, happened in just days.
Yeah.
Our mission here is simple. Unpack these complex moves, give you the essential insights, not just what happened, but, why it matters. Okay, let's get
So it
on it.
was quite a drop. We saw Bitcoin basically give back its recent gains. It fell below that crucial $110,000 mark, and that pulled the total crypto market cap down by, gosh, somewhere between 166 and $200 billion. Astonishing figure. Wow. It's a stark reminder of just how volatile this market can be. We're going to break down what led to this slide.
Yeah, the market just seemed to have hold its breath and then plunge. So what was the fuse? What actually kicked off what some people are calling a flash crash?
It's interesting. It really looks like a combination of things happening at once, a confluence of factors, you could say.
Yeah.
But the main catalyst seems to be what we call a massive whale sell-off.
A whale? Okay.
Yeah, not just any large holder, but a very large holder. Reports suggest one whale dumped around 24,000 Bitcoin. That's valued at roughly, what, $2.7 billion?
Billion with a B.
With a B. And that single action, it wasn't just the sale itself. It apparently sparked over $800 million in forced liquidations across the market.
Okay, explain forced liquidations quickly.
Right. So think of traders using leverage, borrowing to increase their bet size. When the price drops sharply, their positions aren't valuable enough to cover the loan anymore. The exchanges automatically sell their holdings to cut losses. That selling pushes the price down further.
Creating a domino effect.
Exactly, a domino effect. It just shows how one big player can really destabilize things and trigger this cascade.
Wow. Okay, so one player makes a huge move, triggers these automatic sell-offs, but it wasn't just that, was it? Were there other warning signs, technical indicators maybe?
Precisely. That huge sell-off, it basically initiated a technical breakdown. Bitcoin crashed below its 100-day moving average. That's a key line traders watch. Shows the average price over the last 100 days. Often acts as support.
And it broke through that.
Broke right through. And it also fell below something called the Ichimoku cloud, another maybe more complex visual tool for trends and momentum. First time it dipped below those since April. So pretty clear bearish signals, technically speaking. And then sort of layered on top of that was this broader macroeconomic uncertainty. There were some hopes for interest rate cuts after the Fed Chair's Jackson Hole speech, but the tone was kind of ambiguous, didn't give a clear signal, and that spooked the wider markets, not just crypto. Investors got nervous.
Right, seeking safer places for their money, maybe. So Bitcoin's taking this hit from multiple angles. How did the rest of the crypto world react? Did altcoins follow suit?
Oh, absolutely. That's a really important point. The impact wasn't isolated. Major altcoins, think Ethereum, Cardano, Solana, they also stumble pretty significantly. It really demonstrates that old saying, when Bitcoin sneezes.
The rest of the market catches a cold, yeah.
Exactly. Plus, we also had some seasonal factors at play. September, historically, it's often the weakest month for Bitcoin returns. Even in bull market years, the average loss is around 3.77% for September. So some traders might anticipate that, adding a bit more pressure.
Interesting. So that brings us to now. Bitcoin's hovering around that $110,000 mark. What's the short-term picture looking like? Are analysts seeing different possibilities here?
Well, connecting it all, analysts are definitely watching key support levels very closely. Around $108,000 seems important. And of course, that big psychological number, $100,000.
Right. Always looms large.
It does. Some are even putting like a 35% chance on Bitcoin revisiting $100 before the end of September.
Yeah.
But what's really fascinating, I think, is the split we're seeing. A divergence between retail investors and the big institutional players.
Awesome.
Well, you have a lot of retail traders, many who are highly leveraged, facing those forced liquidations we talked about potentially selling off. But then you see institutions like MicroStrategy, for example, they're actually using these dips to buy more Bitcoin, quietly accumulating.
So they see it as an opportunity.
They seem to be playing the long game, yeah. It highlights how those highly leveraged retail positions are maybe more vulnerable to these sudden shocks compared to the patient capital of institutions.
Yeah.
They see long-term potential where others might just see risk right now.
That's a really interesting split. Different playbooks for the same market conditions. Okay, looking ahead then, any potential bright spots, anything that could maybe shift this downward momentum?
Yeah, definitely potential catalysts on the horizon. Upcoming U.S. economic data is key here. We're talking GDP figures, unemployment claims, and especially PCE inflation numbers. That's the Fed's preferred inflation gauge.
Right.
If that data comes in showing, say, a slowing economy or maybe inflation cooling off faster than expected, that could boost crypto prices. Because investors might start thinking, okay, maybe central banks won't need to be quite so aggressive with rates.
Gotcha. So economic data could provide a bit of a tailwind potentially. It's just so clear, isn't it? The crypto market is this incredibly dynamic thing, moved by individual whales, technical charts, big economic currents, all swirling together.
Absolutely, a complex beast.
So as we wrap up this deep dive, here's something maybe for you, the listener, to chew on. In a market that's driven by both cold, hard data and the psychology and actions of a few really big players, where do you think the real power lies? Is it ultimately down to the algorithms and the charts, or is it the decisions, maybe even the whims, of those who hold the most coin? Something to think about.